Welcome back to Global Money Talk live from the New York Stock Exchange. Today is November 5th and it is Election Day here in the U.S. We'll continue to keep an eye on what happens as we edge closer to the end of the day. Now, Kamala Harris does want to raise taxes on the rich while Donald Trump wants to cut income taxes and raise tariffs. If either party controls both the White House and Congress, it will be clearer if these plans become law. We all know a divided government could mean less action. But both presidential candidates propose expanding tax credits or removing taxes on Social Security and tips. But these policies will need to be paid for, possibly by raising tax rates. Back in 2017, Trump passed a tax cut law that lowered taxes for many, but those cuts expire at the end of next year. Meanwhile, Harris does propose a 28% capital gains tax for high earners and a surtax on investment income. Trump, meanwhile, wants to extend the 2017 tax cuts, but taxpayers worry taxes could still rise under him due to the nation's economy. Well, joining me this morning at the New York Stock Exchange is Danielle Pan, Vice President of the Lakeshire Group of Raymond James. Thank you so much for joining me today.
Oh, it's my pleasure, Remy. Glad to be here.
Well, the countdown is on. We've been anticipating this day for many weeks, many months. So first and foremost, give us an understanding of what we can expect, and in terms of what you've been telling your clients, what has the tone been and what have you initially been telling your clients?
Sure. No, it's a great question. So, it's a question I probably get asked multiple times a day from different clients. And, while I do point out that there tends to be heightened volatility kind of leading up to the election, the winner itself rarely has, much effect on the market. In certain situations, Republican markets have performed a little better. In other time frames, Democrats. So the message really for us is just to, stay the course, and then when the victor is declared, if there are any rebalances or any changes that need to be made, let's do that. But for now, we are entering the seasonally strongest part of the year for the market. Elections are themselves a catalyst, so if anything, it's maybe even a time to put a little risk on if you're feeling inclined.
And I think one very key thing here is to take a step back because there is a lot of noise this election cycle.
Sure.
And when we look at the Dow, the NASDAQ, S&P 500, we're still holding on to double-digit percentage gains for the year. But when it comes to taxes, Dan, I do want to ask you this. How might tax policies differ under a Democratic versus a Republican presidential administration?
Sure, that's a great question. And you did kind of tip on some of that, mention some of those things, but really, when we talk about it from an income tax level, Trump would likely allow the 2017 tax cuts to expire and would likely want to keep them in place. I mean, even potentially lower them, whereas Harris would potentially raise the top level, and she would focus her efforts kind of taxing the ultra-wealthy and the corporations. She is actually giving more for child tax credits and deductions than Trump is, which is going to help a lot of families. It's a good thing. And then, the corporate tax rate, again, Trump will likely try to decrease it, maybe even to 15%, where Harris will keep it kind of constant, probably not increase, but, keep it constant. And then one other thing is really estate tax. So the current estate tax exclusion right now is close to $14 million. If Trump were to get in, he would most likely look to keep that in place, whereas Harris may look to take that down to closer to $3.5 million. So, it is a big difference. It just depends, what type of person is going to affect it,
And there is a saying here in America that when it comes to certainty, death as well as taxes are a certainty.
It's always certain.
And we know there's been so much uncertainty this year, whether we're talking about monetary policy, when and how the Federal Reserve will move. But here we are on Election Day, and we're looking ahead to the rest of this year. But of course, what sectors are you paying attention to? Because as I mentioned, we've been seeing strong gains for the S&P 500, up 20% year to date. And some of the sectors that we've been seeing strengthen, not surprising given the AI play here. communication services,
Sure.
IT, and of course utilities when it comes to that AI play as well. But we're also seeing financials higher as
Sure.
well.
Sure.
So in terms of sectors, what do you think will do best depending on who ends up victorious or irregardless?
That's a great question, and I could probably give you our sector outlook for both people winning, but one thing that I've focused on with my clients is what sectors or what subsectors are going to perform well regardless, right? Because I feel like we have a little more control over that, and the more information you have, the better your investing typically is. So, for us. We really like the energy sector a lot because we believe that just because of some of the deglobalization and onshoring, we believe that there's going to be a lot more energy permitting that's going to allow for more fracking and more domestic energy production. And again, that's kind of regardless if Trump or Harris wins, right? So we like that period. Even critical minerals, if you kind of follow the same rationale as the energy reform, critical minerals, whether they're used in batteries or other computing parts, that's also something that's kind of coming back with the onshoring and protecting your assets. So we do think that the critical minerals space is going to get paid a lot of attention to, and something that's going to work well. And then AI, we love it. I mean, Palantir's earnings yesterday were fantastic, and the AI revolution's here and it's going to continue. So, we can always stay with that. I love AI, but I think one thing we've noticed is that there are some technology restrictions, coming in with China and with Huawei and sending chips over and whatnot. So, we think that if you're owning tech companies, you really have to know what their China exposure is. Because that's always a potential issue. And then, last but not least, let's see what we got. We also think the semiconductors are going to be a good place to be because it's the similar theme as the minerals and the energy, but with the onshoring and us wanting to have greater control of our infrastructure, we think the U.S. is going to pay extra attention to semiconductors, and we like that space.
Well, Dan, it does sound as though there are a lot of moving parts here, especially when you go sector by sector, because whether we're talking about critical minerals or energy or even semiconductors,
Sure.
We know that each sector has its own opportunities as well as risks. And I'm sure one thing that your clients have been asking you is about monetary policy here in the United States. And we know that depending on the cycle that we're in
Sure.
and what the Fed will do next in terms of the long run, it will affect businesses as well as investors. So what is the conversation that you're having right now regarding the rate outlook here?
Sure. No, it's good because the funny thing is that rates have really increased since the rate cut. I think markets got ahead of themselves. The 10-year was trading well lower than it is now. The Fed cut, and then we had some surprisingly good data. So we do think the Fed is going to continue its cutting cycle, right? We stick with the Fed guidance because it always makes sense to do so. But we think that the Fed is in a very good spot now because the data continues to come out good. ISM was positive this morning, and yet our main inflation reads are still coming down. I mean, there might be a blip here and there, one being slightly higher month over month, but we think the Fed's in a little bit of a Goldilocks scenario right now from an interest rate outlook. But keeping in mind that interest charges on our debt are one of the biggest spending things that the government has. The government wants yields to be lower, so we do think that they're going to follow through on their rate cutting outlook. It's just while the data is good and they might go a little slower than originally thought. But I'm a big proponent of bonds, and I'm a big proponent of locking these rates in right now.
And the bond market is something that we are keeping our eyes on as we head into not just the rest of this month, but the rest of this year as
Sure.
well. And speaking of which, it did seem as though all year we're counting down the days to November 5th, but the countdown to Thanksgiving, the holidays, year-end
Sure.
is already on. Hard to believe, but here we are.
Sure.
And this is also the time of year, I'm sure, that you're getting approached by clients asking how to save on taxes. So give us an idea of some of the tax planning that you're doing with your clients and some of the conversations that you're having right now.
Absolutely. So if we could bring up slide 1 when you get a chance, that'd be great. So, I know it sounds a little overly simple, but, we have a couple great year-end tax planning guides. And, what I like about using these guides is that it's going to force conversations anywhere from health savings accounts to 529s to gifting stock. You can see right here on the worksheet that, the first section, considerations, will you be subject to taxes on distributions from investments? Certain investors have the ability to either withhold income or defer it to a later date, and sometimes that makes sense depending on where you are currently with your taxes. But this is a great document. It's very encompassing, and we've had great conversations from it. And I mentioned the health savings account before, and it's not a very large amount because a family can put $8,550 into a health savings account. But you can invest that money if you don't spend it all on health care. But that is true tax avoidance. It's not deferral, right? So we're a big proponent of maxing that out if you can, and whatnot. And then I would say, even the next bullet point, have a fully funded education savings account. Certain states allow deductions when you contribute to a 529. So it's really my job to make sure that we've checked every box, right, and that we're trying to squeeze out as much as we can. And this guide has helped in the past. A few years ago, a client of mine had a very high growth private company, and when we were doing our year-end tax planning, I suggested using an illiquidity discount to remove some of those shares out of his estate, right? So that was a home run because the company has increased revenues 200% since then, and the stock has probably doubled. So he was able to get a lot more of it out of his estate because we were proactive. So, very good document that we use. And then, let's see. And then you can even see, right, this is even good for small business owners. So it's going to ask them if they're eligible to contribute any more to a retirement plan. And then typically I'll take it a step further where we make sure that retirement plan is efficient as possible, right? Are the fees as low as they should be? Is there good corporate governance? Are all of your employees contributing to the plan? So we make sure it's a very healthy plan fiscally, and that the business owner is doing the right thing. And and then there's charity, there's estate planning. So it's definitely a conversation I'm having a lot with now because, as you said, taxes are a certainty, and anytime I can reduce those, that's a win for everybody.
And I know that as we continue to move through this year and head into year end, you're going to get these questions, but are there any changes in terms of contributions that people should be keeping in mind, whether it's small businesses or individuals?
That's a great question. So I don't have the exact numbers available, but I can tell you that it seems like every year the amounts that you can put away go up a little bit. The health savings account used to be $7,000, now it's $8,550. 401k contributions are going to go up significantly. Even the amount a business owner can put away in a qualified plan is probably going to go up. So, for those that have the ability to put money away, there are a lot of tax savings that are going to happen in 2025 from the higher addition amounts.
It does sound as though some of those amounts are minimal, but that can all add up and make a difference. Sure.
I mean, I'm going to go back to the health savings account a third time, but if you think about it, $8,500 you're putting away. You're paying your health care with pre-tax dollars, which is a good thing. But if you don't spend everything every year, and every year you keep putting that in, over a period of time, that's going to be a significant growth that you've created, but significant tax savings as well. So, as you said, if We go through this every year, right? We're not looking to make any huge changes, but as long as we know that we've squeezed every tax savings out as possible, over an investing lifetime, that will be considerable savings.
And Dan, now I want to shift our conversation over to direct indexing.
Sure.
So for our viewers who might not be as familiar, can you explain why this is and why this matters?
Sure. So could we go to slide 3, please? All right. So just bear with me 1 second. Okay, so direct indexing is actually kind of the newest version of passive investing, and it's something I do a lot because inherently with direct indexing there's a tax loss harvesting component. But essentially, if we think about passive investing, started off with some index mutual funds in the 80s, moved into some ETFs, which are still huge, but we feel like direct indexing can actually add more tax advantages. So really what it is, direct indexing is, it provides index-like returns by investing in a separately managed account the underlying securities of the index, right? You might, if you own the if you're trying to replicate the S&P 500, you might not own all 500, but you're going to have a very equal weighting of all the sectors, and in the end, the performance is going to be very much like the index itself. What's different about this versus an ETF or an index mutual fund is that the portfolio managers will look to continually realize losses, right? So if you think about the S&P 500, on any given year, even when it's up, right, you could have 10 to 20% of the stocks have actually finished the year with a negative return, right, even though the index as a whole is positive. So what we look to do is we look to harvest those losses, right? So if you have a loss on Walmart, right, we'll sell that, we'll buy Home Depot. Maybe if you have a loss on Coke, we'll sell that, we'll buy Pepsi. But by continuously harvesting losses and then of course replacing, what you do is at the end of the year you have all these short-term and sometimes long-term losses that you can use to offset gains from the portfolio itself, or if you have gains from another sale you did. Active tax loss harvesting will help out, and it's going to change. Like a year like 2022, the losses that were realized were much bigger than a year like 2024, but the tax alpha that the loss harvesting can give you can be anywhere from 1 to 3% a year in normal circumstances. So it's something that we like a lot, and the other reason we like it is because it can be customized. So if we can now go to slide 4. We'll talk about some of the customization features. All right, so when we're talking about direct indexing, there are plenty of indexes to choose from, right? You've got the S&P 500, the Russell, MSCI EFA if you want to do international, but we can do a lot more than that. So we can put different screens on there. We can choose something that's maybe you want to do all cap because you like the small cap and the large cap combined. As I said, international. But what's interesting is that we can also do what's called style tilts. So we can take the S&P 500 and for younger clients, maybe we can put a growth tilt onto it. So it'll have more of a growth emphasis to it. Whereas if older clients that need income are doing direct indexing, then the tilt we're going to put on there is enhanced dividend or maybe an income tilt, right? So that in this portfolio will hopefully throw off more income than the index. And then also, there are people that just say flat out, I refuse to own certain industries, whether it's, defense industries or gambling. They just won't own it at all. So most direct indexing companies have the ability to just completely exclude a certain subset of stocks. So, we think it's great because customization for the client, constant tax loss harvesting and tax alpha, and index-like returns, because most active managers don't outperform the benchmark, so this kind of gives you a little of everything.
Yeah, I think you've given us such a great overview of what direct indexing is, and even some of the tilts there, I think that's very helpful.
Oh, thank you.
Yeah, especially if you're thinking about the time horizon for investing, older person who might be edging closer to retirement or
Sure.
perhaps is in retirement versus someone who is just starting out on their investing journey.
Sure.
So when it comes to direct investing, is it for everyone, or are there some pros and cons that you would like to highlight when
Sure.
it comes to direct indexing?
Sure. So if we could just go to slide 5 now. So the main thing I would say is that you never use IRA or qualified assets for direct indexing because the only tax ramifications occur when you take the money out. So this is strictly for taxable assets. But people that use direct indexing, they could have a liquidity event where they want to sell a home or they've sold a business, and yet they want broad market participation, but they have losses to offset elsewhere. So they'll use this direct indexing in the beginning of the year to build up the losses. That way it'll help offset the gains they had elsewhere. Some people that don't believe in active management, that purely believe in passive, they will probably go to direct indexing because they're going to get the index-like return, plus they're also going to get the tax alpha. So this can very much be a core allocation as well. It doesn't have to be a specialty strategy. And then this is actually something I just did the other day, but we had a family set up a trust, right? Revocable trust, put the house and some of their taxable money in there. But the problem is that the trust, assets held in trust, will often get taxed at the highest ordinary income tax rate. So, that's not a good thing. So what we tried to do is, in this case, right, we're actually going to go for what I mentioned before. We're going to go for an S&P 500 index with a growth tilt and minimize income. Because if we can use the losses to offset gains and it's not throwing off a lot of dividend income or other interest, that's a pretty tax efficient vehicle that I can use in a trust. So I would definitely say direct indexing is good for trusts that are in the highest tax brackets.
Yeah, I think it's also very helpful to talk about different scenarios here when we're talking about something like direct indexing.
Sure.
Because each case is quite different, and when you're bringing in a trust, that's also very different from, say, an individual who is not relying on a trust.
Exactly. Yeah, I mean, every situation is a little different. One thing that we actually do, and direct indexing has helped me also, is that I've had clients that had legacy managers, right? And the manager did great years ago, but unfortunately, for whatever reason, he or she is underperforming now. But clients got huge unrealized gains in this manager. So, they might not be happy with the current performance, but to just sell the manager out, that's going to be a problem. So what we can do in a situation like that is using direct indexing. We can do what we call a tax transition analysis, right? So the PMs will basically compare the portfolio to whatever index it looks like the most, right? We'll agree on some kind of level of tracking error, which means that we don't want to realize all the gains right away.
Okay.
So by not doing that, we realize that performance may be a little different from the index, but at least for now, the goal would be to preserve, not to trigger the taxable gains. Whereas, other investors might say, no, I really need to match the index as much as possible. Just realize as many gains as you do now. So it just comes out to what the client wants. But these tax transition analyses are a great way to get out of underperforming managers with large gains. Sorry.
And when it comes to this tax transition analysis, can you walk us through this process? How does it actually work?
Sure. So, basically, the tax transition manager is going to take all the holdings and their weightings within the portfolio, and we're going to try to find the index that the portfolio best matches to. And most of the time, it's going to be whatever benchmark the manager compares herself to or himself to. But in this case, we try to find the appropriate benchmark. So let's say we have a portfolio that does actually look like the S&P 500. As I mentioned, the manager will give the client, say, 3 to 4 different scenarios, where we'll say, this scenario is going to cause the greatest amount of tax, but it's going to give you the smallest tracking error. And then vice versa, we can have one scenario where the tracking error will be big, but the manager is going to realize gains over 4 years. So the client can deal with the tracking error because he wants to push off those taxes. So as I mentioned, it just comes down to what the client's comfortable with, but it's very, you can see through it. We show everything totally clear and transparent, and the client always knows exactly what they'll get when we do these.
And finally, Dan, before we wrap it up for today, I do want to ask you, I'm sure you've been advising clients throughout many market cycles, election cycles, and we're here about to head into year-end and wrap up the quarter as well. But as we look beyond 2024 and into 2025, what are some conversations that you're having with clients about what to pay attention to?
That's a great question. I would say this market has lasted quite a long time. It's one of the few times that a soft landing seems to be engineered out of a large rate increase. So I would say statistically a recession is due at some point, right? Doesn't mean it's going to happen next year, but it could. So I would just say, after the election frenzy goes away, and after the the market goes through its strong part of the year, let's just make sure that the data continues to surprise for the upside next year, and let's make sure that everything's healthy, because if that's not the case, if all of a sudden growth starts to slow, the market is not priced for that. Not to be Debbie Downer, but as a risk manager, that's always my job, is to look for the problem and hope it doesn't exist, but at least to be aware of it.
Yeah, you bring up that key word there, and that is risk, because if we look at the equity markets, as we mentioned at the top of our interview today, the double-digit percentage gains that have continued despite all of the volatility we saw this year and through all the unpredictability, because heading into 2024, there had been expectations of rate cuts from the Fed, and that had driven the market gains seen at the end of last year in 2023. So here we are in November. We got the first rate cut from the Fed in September, and we're fast approaching the November meeting, and there are expectations for further cuts. But we know when we're talking about things that investors, consumers care about, property prices, housing, a lot of that does hinge on interest rates and where the trajectory goes for the Federal Reserve.
Yeah, and as I mentioned, it's a great time to be locking rates in. Especially since rates have backed up since the cut. So if we follow Fed guidance and buy some longer maturity bonds, I think we'll do fine.
Okay, Dan. Well, thank you so much for joining me here at the New York Stock Exchange.
My pleasure. All right.
Thank you very much. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here bright and early tomorrow morning. Have a great day.